Hey everyone, how's it going? It's Russell here, and in a rare move, Tiff Macklem, the governor of the Bank of Canada, wrote a message specifically for Canadians and had it published by the Financial Post just yesterday. And this comes after we got some new inflation data from Statistics Canada that confirmed that inflation in Canada would be above target for 3 months in a row. On top of this, Tiff Macklem's former boss, the guy who used to have his job, came out and said that he didn't like the way that the Bank of Canada was communicating things to Canadians. And on top of this, some MPs are saying, hey, maybe the Bank of Canada isn't as independent and unbiased as we previously thought. So in today's video, we're going to go over exactly what this new inflation data is, what the Bank of Canada wrote for you to hear, as well as the comments and concerns from other high-ups about exactly what was inside that letter. But before we do, make sure to check out the links in the description where you can open up your own investing accounts or even learn more about building wealth right here in Canada with the Canada Money Mastery program. Okay, let's get into this new inflation data first. This is the chart for the CPI, or the Consumer Price Index, the number that we use to measure inflation here in Canada. And you can see that new data just came out as of yesterday, showing that in June of 2021, we had 3.1% inflation, down from the previous month at 3.6, but still well above the Bank of Canada's target, which is 2%, and they're comfortable within a range of 1% to 3%. And some of the reasons that we've actually seen inflation go down here is because of what central bankers call base year effects. Essentially, these numbers sort of compare to the previous year at this point, and you'll see back in June of last year, we actually saw a sharp rise of inflation. So when you're comparing to that previous number, the number from June as of this June is actually lower than when you're comparing May to May, where we had low inflation and historically high inflation. And anytime inflation gets outside of that 1% to 3% band that the Bank of Canada is targeting, well, central bankers are supposed to be a little bit worried, and that's exactly what Tiff Macklem wrote this message to Canadians all about. Let me show you some highlights from it. Typically, the governor of the Bank of Canada will sort of wait for a press conference to be able to talk about these changing numbers, but it seems like it was pretty important for Tiff to get out in front of this and write an article that was to be sent out to Canadians. You can see right here, this article was authored by Tiff Macklem, again, the governor of the Bank of Canada, and there are some highlights that I want to share with you. We're not going to go over the whole thing, but just some highlights, some key points. First of all, what I found interesting is he acknowledged that many Canadians don't believe that the CPI actually accurately reflects just how much inflation they're seeing in the spending that they have to do in their day-to-day lives. And they highlight that here, saying many people told us they manage their expenses carefully and rising prices make it hard to pay all their bills. And we heard from people who feel the Consumer Price Index doesn't always reflect their experience with inflation. He then goes on to say that Stats Canada has updated this basket of goods and services that make up the CPI so that it would better reflect how buying habits have changed recently over the course of the pandemic. But this doesn't really answer some of the larger questions and concerns people have about the CPI, largely that it doesn't include many of the things that people actually are having to pay more and more for, including mortgage interest costs, because of the fact that mortgage interest has actually gone down. Even though housing prices have gone up, it's not really reflected in the rising CPI. Then in these 3 paragraphs, he goes over answering the question, why is inflation higher now? And he has 3 main answers. The first one is what we already talked about, something called base year effects, where you compare the inflation data, or the number for the CPI actually compares to the previous year in the same month. So he's saying because we had low inflation at the beginning of the pandemic, that's why we're seeing high inflation technically in the numbers right now. And then he adds on some other things like gas prices. Remember, we had low gas prices at the beginning of the pandemic, now we have them higher. So he's saying, hey, that's factoring into the CPI data that we're seeing now, that's historically high. And then he also mentions that because of different supply chain bottlenecks and difficulties in shipping and production of goods, we've also seen a sort of temporary, in Tiff Macklem's eyes, reduction of our ability to actually purchase the things we want, causing price spikes. His final few points here end with a prediction on when they're going to raise interest rates, and they say that that likely won't happen until the second half of 2022, and that's not a lot of news. We've sort of had that sort of date from the Bank of Canada for the past while, but then he goes into a part where he's trying to sort of reassure Canadians that the Bank of Canada has their back, saying that they're going to keep inflation low, stable, and predictable, even with the gyrations caused by the pandemic, inflation has been pretty close to target through the past few years to today, and you can be confident that they're going to keep the cost of living under control, and saying that they remain just as determined to secure a complete recovery and keep inflation under control. But, and here's where things get interesting, David Doge, the former boss of Tiff Macklem, David Doge was a previous governor of the Bank of Canada, has come out and said, hey, I don't think these reassurances that you're giving Canadians are all that accurate. And it's always interesting to get the perspective of somebody who used to work as the governor of the Bank of Canada and has now moved on to the private sector, because now they can say whatever the heck they want. And the main thing that he's worried about is that Tiff Macklem's assessment of how long inflation is going to be around here in Canada is off. I'll show you what I mean. David Doge here is saying that there's a chance that the underlying price pressures in the economy remain above their comfortable band, that range of 1 to 3%, all the way into 2023. And he says that by insisting it's all temporary, they tend to undermine their own credibility, which is unfortunate. He goes on to say that he thinks that their language will be a little less on the temporary aspect of things and greater recognition that there might be more longer-term pressure in the system, and that's likely going to come at the next rate decision from the Bank of Canada that's scheduled to happen in September. So he says the Bank of Canada is losing its credibility by emphasizing that the inflation we're going to see is only going to be transitory or short term. And even if we do see interest rates rise over the long term, the Bank of Canada might not have a lot that it can actually do, because if it raises interest rates too much, it might end up bankrupting the Government of Canada. You might remember that in April, the government announced its biggest budget yet, with the most government spending and most government debt that we've seen in a long time, with the logic that, hey, interest rates are super low right now because the government or the Bank of Canada has set that, so why don't we lock in a whole bunch of debt so we can spend more now and pay less than we would if interest rates were higher. I've gone over these specific numbers in previous videos, but think of it this way. As the government takes on more and more debt, also the interest payments on that debt go up. Now, if the Bank of Canada were to raise their interest rates to a certain point, the Government of Canada may not have enough money from its revenues, like taxes, in order to pay just the interest payment on the debt it currently is holding. If you're the Government of Canada and you want to make more money from your tax revenue and you want to spend more money in the short term, then it makes a whole lot of sense to want extremely low interest rates for the long term. Low interest rates are directly tied to higher housing prices, and if you're the government, that means more tax revenue for you, whether it's property tax, land transfer tax, capital gains tax, and on top of that, businesses, as there's low interest rates, are incentivized to borrow more and more, meaning that the government again gets more sales tax and more income tax. And on top of all of that, if we see Canadian real estate continue to go up and to the right, well, the owners of that real estate are going to feel more and more wealthy, spending more in the economy and generating more revenue for the government, as well as improving economic indicators that often politicians use to say, hey, look, we're doing a really good job. All of this to say that the Government of Canada directly benefits from low interest rates, and historically, the Bank of Canada and the Government of Canada, they're supposed to be totally separated. The Bank of Canada is supposed to be a totally apolitical party that doesn't take any sort of advice or points from the Government of Canada or any political party that's in charge of the Government of Canada. But over the past year, certain accusations have been targeted at the Bank of Canada saying, hey, you're not acting entirely independent, and it comes largely from a member of Parliament in the Conservative government. This is Pierre Paulier. He used to be the finance critic for the Conservatives against the Liberals before Aaron O'Toole sort of shuffled around those roles and he lost his job to Ed Fast. He accused the Bank of Canada of not staying politically neutral and actually financing Prime Minister Trudeau's historic amounts of spending, sort of calling it as an ATM for Prime Minister Justin Trudeau's emergency pandemic programs. The reason he claims this is because of the Bank of Canada's new quantitative easing program that started at the beginning of the pandemic, otherwise known as QE, where the Bank of Canada essentially creates new money in the system to buy up government debt on the secondary market, essentially financing whatever the government wants to spend. Then he ends with a statement that some Liberal supporters and NDP supporters might be surprised to hear coming from a Conservative, because he talks largely about wealth inequality, and he says expanding the bank's balance sheet during a short-term, once-in-a-lifetime pandemic lockdown is different than perpetually buying and inflating the financial assets of the wealthy at everyone else's expense. Trickle-down economics does not work. We need a bottom-up, worker-led recovery. And these massive QE programs that have been implemented across the world, well, they have done just that, raising the price of assets like real estate and stocks, making the wealthy wealthier at a time when many of Canada's and the world's poorest have been struggling most. But this overall problem of raising interest rates when governments have taken on historic amounts of debt, well, it's not Canada's problem alone. The US as well as the EU and Australia, among many others, have done the exact same thing, added more money to the system and borrowed more, and they're sort of in a sticky situation if interest rates rise. And I'm curious about what you think about all of this. Do you think that interest rates may rise in the future, potentially putting the solvency of worldwide governments at risk? Or do you think that central banks will keep on sort of controlling interest rates and keep them low for the long term in order to avoid something like that happening? Let me know down in the comments, and while you're down there, if you haven't already done so, open up a Wealthsimple trade account where you can get 2 free stocks, or check out the Canada Money Mastery program where you can get 40% off with the coupon code GROW, where we talk all about building wealth right here in Canada. And with all of that said, thanks so much for watching, everybody. I really hope this video has helped you out at least a little bit, and I'll see you next time.